it's Sarah Larbi, producer and host of Everyday Investor. Thank you for tuning in again this week. We've got a great show, but the goal of Everyday Investor is to provide you at home the education and the knowledge and the tools and skills and power team so that you can get to that next level, create your freedom, and leave the 9-to-5 job if that is in one of your goals. And today we are going to be talking to Kyle Ford. We're going to be talking about a really cool deal and also answering your mortgage questions. So thank you for submitting them on our Instagram account and on our website. We are going to take some of those questions and ask Kyle. So stay tuned.
Are rates going to go up or rates going to go down? The answer to both questions is yes. Rates are going to do what rates are going to do.
The mortgage world has changed. Has your advice? Are you looking for a modern approach to your mortgage planning process? Advice tailored to your unique, ever-changing circumstances? Whether you're upsizing, downsizing, purchasing, or refinancing, the Kyle Ford Mortgage team works with individuals and companies to custom tailor the right mortgage product for you. Working with a wide selection of lenders, we're here to serve our clients and help them achieve their real estate and retirement goals. Contact the Kyle Ford Mortgage team today, Canada's mortgage choice.
Hey, it's Sarah Larbi, producer and guest host of Everyday Investor. We are talking to Kyle Ford today, but before we do that, let's find out what is happening in the world of stocks.
Thanks, Sarah. Omar Khan, guys, here with Data Trading Weekly Market Update. Now, the markets pulled back a little bit last week because of this nasty word that keeps coming up, inflation. I'm sure you've seen it in the grocery stores, out and about. You're probably seeing prices go up. Now, inflation is not the best thing when it comes to the market. Stock market gets a bit worried because future expected growth could be expected to be lower because central banks would have to raise their rates. Now, I don't want to get too much into what that means. Basically, the fear is interest rates could go up, therefore slowing down economic activity. What's happening right now, though, is that corporate earnings, the amount of money companies are making, are still coming in very strong. So the market keeps pushing all-time highs. Now, that will continue, but we're going to have to keep an eye on this nasty thing called inflation and to see if corporate earnings keep coming in. So far, so good. And we're about to enter the good part of the year statistically with November and December, which is supposed to be a really good time of the year for the stock market. So let's see what happens.
Kyle, welcome. How are you?
I'm doing well, Sarah. Thanks for having me on today.
Absolutely. I'm excited to talk about financing, refinancing, all of that good stuff, because ultimately I think my favorite part of real estate investing is when we get that check from the refinance. But before we get there, I want to go through some questions that we have been receiving from a lot of our viewers about, financing and refinancing. And so I'm going to throw a few at you, and then we can have discussions around them. Are you ready?
Great. Fire.
All right. So one of the questions that has come from somebody, they were wondering, how do you get past that 5 property mark? So they have a handful of properties and they're finding that it's getting a little bit harder for them to maneuver with the big banks and be able to get that financing. What are some insights or some tips that you can suggest?
When you build a house, you don't slap a roof on and then try to put the foundation underneath. So often when it comes to getting past the 5 financing wall, you might want to look at your first 5 properties, including your primary residence and your rentals, and making sure the debt on those properties are structured properly. The advice you may have gotten on some of your first financing transactions may have been designed to pay the mortgage off. If we're a real estate investor, we might not want to pay our mortgages off. So there could be some things that we do, like monthly payments versus biweekly, extending amortizations out to 30 years, as well as maybe moving to a variable rate product at a lower monthly debt service rate than a fixed rate product to decrease our ratios. So sometimes before we bust through that 5 property wall, we want to take a step back and look at our first 5 properties and make sure our debt is structured properly.
Amazing. So some great insights there. And the other thing I would just say is I think a lot of people are really focused on going to the bank, working with the bank, and at some point they're going to say sure, and then at some point, maybe 2 or 3 or 4 or 5 later, they're going to say, sorry, you don't fit into this little box. And one of the biggest mistakes that I've made in the beginning was going directly to one of the big banks and not working with a mortgage broker. And originally what they wanted was 25% down, and they wanted 35% down. And this particular bank was not very investor friendly for scaling. but there are going to be different lenders, different banks, there's trust companies and all that good stuff out there, and they're going to have different criteria. Can you give us some insight on that?
Yeah. So when you go to a big five bank, they might only allow 50% rental income. So if you're buying properties, depending on the area you're buying, that could be a real challenge to be buying multiple properties, only allowing 50% of the rents. There are banking institutions that will allow 100%. There are also alternative lenders that will offer higher debt servicing ratios. So one insight that I'll add is you can get to 10 properties in A-rate financing. You can even get to 15, depending on your strategy of getting there. By and large, most people may need to start using alternative lenders. As a real estate investor, we can't be as rate sensitive. At the end of the day, the difference, if your property doesn't work at 3%, maybe it's not that great of a deal to begin with. I hate to be the bearer of bad news. But so using some of those alternative lenders that you talked about, credit unions are great right now. They have a very, very large appetite for investor type deals in a holding company, which is what a lot of investors want. Alternative B lenders. There are B lenders who have no property cap. They might only lend you 5 mortgages at their institution, but if you have 20 properties, they don't care. As long as they all debt service, they'll add another 5 to the mix. So that's where a mortgage broker can really step in and provide those alternative solutions. With that being said, right now, big banks do have a good appetite. There are times as a mortgage broker that I might be bringing you directly to a big bank, but that's at the right time in the right place. We also need to make sure we're using our alternative lenders as well.
All right, some great insight. So we had a question on our Instagram account, Everyday Investor, and we had Mary asking about how do you finance a recreational or cottage property. She's looking at potentially buying something in Muskokas, Kawarthas, etc. That's probably quite a big difference versus your traditional investing where you're putting in a tenant. What insight can you share with Mary?
So this is a space I'm very familiar with. I'm quite active in the cottage rental space. And here's what I'll say. If you're buying your first one, it's a lot different than if you're buying your second. So if you're buying your first cottage property and you have the income to support it, you could finance this as a secondary residence with 20% down, not a lot of trouble, great rates, great terms. The second you move into, I'm buying a rental cottage, it completely changes the financing perspective. So there are specifically one AA lender that has an appetite for these type of properties when they're disclosed as a short-term rental. And then from there, you're pretty much going straight into alternative lenders. So you need to really fit in that A-rate box to get the one lender. But from there are several alternative lenders who will allow you to use Airbnb income to qualify and service these properties. You're just going to pay a higher rate. The great thing about Airbnb short-term properties is they can support it. The revenue that these properties are generating can support a higher interest rate. So one of my great mentors in real estate tells me all the time, don't be cheap, Kyle. If you got to pay a little bit higher rate and get you into a better deal, do it.
Absolutely. I'll tell you, as a real estate investor, it's about the terms, it's about the flexibility so much more than it is about a 3% or 4% rate. Ultimately, at the end of the day, it's all pretty much very, very cheap money in comparison to, where we were 10, 15 years ago. It's not about the rate. It's what's the deal? What is the deal going to bring you? And then, what terms are you looking at and what's the flexibility like? So that is awesome. And obviously we want to try to bring in some more questions to you from our audience. And one of the things that we had a couple questions about was, should I incorporate, what are the pros and cons for some of those lenders, as you're scaling and you're growing your portfolio? And I know that this can differ if you're asking your lawyer and your accountant and your mortgage broker. But from a mortgage broker standpoint, what insights can you share about the pros and cons of putting, mortgages, instead of you personally on title, having the corporation go on title?
My answer is a 3-tier answer. There's a financing perspective, there's a tax perspective, and there's an asset protection perspective, or as I like to call, anonymity. There's 3 benefits. First of all, you can be a little bit more secretive about who you are. Your name isn't on title. There are tax benefits to incorporating. And from a financing perspective, there it does limit your lending pool. I'm not going to be I'll be upfront about that. There are certain lenders who are just not interested in dealing with the corporation. However, there are absolutely lenders who have no issue with it. If you're buying a residential type property in a corporation, it will be qualified in most scenarios based on your personal income, the property income, and they just register the title in the corporation. So they use your personal income to qualify, and they register in a corporation. If you're buying commercial, 5 units and up, that will be qualified based off how the building produces income, and the lenders candidly expect you to have a corporation. If you're buying a sixplex, they're expecting you to have a corporation. If you're buying 1 to 4 units in a corporation, you will limit your lending pool. However, I like the tax benefits that come with incorporating. I like the anonymity. I like the ability that nobody sees Kyle Ford as the property owner. It's Ontario Company XYZ. And as long as you tell your financing expert up front that you're going through a corporation, it will pivot the direction they go, but you can still get A rates. You can still get the 20% down, variable rate, 1 point, whatever terms right now. So just the key is don't drop this on your financial professional at the 11th hour, because it will be a problem. I can assure you that.
Absolutely. Have that conversation with your mortgage broker. Make sure that they understand the strategy, the exit as well. I mean, even just thinking about it, like if you're doing a flip or you're doing a BRRRR or you're doing a buy and hold, you're likely going to recommend something different for all of those scenarios and situations. Like you talked about fixed versus variable rate. Well, if you're going to be refinancing, do you really, really want to be in a fixed rate? Can you share some insights on that?
Yeah. So the conversation I have with my clients is, are rates going to go up or rates going to go down? The answer to both questions is yes. Rates are going to do what rates are going to do. What I try to move the conversation to is asset liquidity versus payment stability. A fixed rate gives you payment stability. You know what your payment is every single month. With that being said, if you need to sell or refinance the asset, you could be looking at a substantial penalty because that rate was locked in. A variable interest rate gives you asset liquidity. You can sell or refinance at any point with a 3-month interest penalty. It means if something happens and you need to get out of this deal, or you need to change the debt structure of the deal, you have a consistent, predictable penalty that you know what to expect. So another, I can tend to be a little bit blunt with clients about this, but if you're talking about a fixed versus variable, and you say, yeah, I could take a fixed rate, but my payment could go up $25 a month. It could go up $50 a month. Once again, is it really that great of a deal if $50 a month is going to make or break you? I would argue that it's not.
Yeah, absolutely. I mean, maybe your deal is not that great if that is going to make or break you by increasing it. A couple questions that we did have is just, I mean, obviously nobody has a crystal ball. You and I don't have a crystal ball, but rates have been at an all-time low for so long. And if you have a portfolio, and again, I know this is case by case basis, but are you suggesting that people can look at what they're, paying right now, potentially do some properties fixed in maybe forecasting part of the future of rates increasing? Like, I don't know if you've got any insights on that, like in the next 2 years, what you think is going to happen, and then maybe some recommendations on that.
So here's what the first answer I'm going to have. If you have a spouse or business partner on a deal that is going to be stressed out about interest rates, and that's going to cause other challenges in your partnership, you need to do what's best for that partnership. And if that means locking in rates to make everybody sleep at night, then that's the choice of that relationship. My argument is going to be still that if you're concerned about rates, if your thought is that rates are going up, the question we need to ask is, why do rates go up? Rates generally are used to curb inflation. So they use interest rates to slow down inflation. If we're predicting that rates are going to go up, we're also predicting that inflation is going to keep happening. If inflation continues to happen, what's happening to my property values? They're likely going up, which means I'm probably going to want to change the debt structure on my property within the next 2 years anyways, which is why I still want a variable interest rate. I likely will want to tap into that equity to either private lend or buy more properties. So I wanted just to preface this with, this is comfortable for many of my investor clients' appetite profile. We've had many conversations over the years. They've been riding variable rates and they're comfortable with it. If you're not comfortable and you're going to be waking up in cold sweats at 2 a.m. over the interest rates, please lock into your interest rates. But if we want to talk about some of the economics of it, I go variable, and I recommend a lot of my clients do the same.
I agree. I mean, I'm variable right now. I've locked one in, and I kind of regret that because I'm like, I could have refinanced and taken some equity, but it costs a lot of money to refinance something that you've got, a fixed term on that has a lot of time left. This is really insightful. What we're going to do after the break is dissect one of your client deals, recent deals. So guys, don't go anywhere. We will be right back.
At Theta Training, our goal is to help you achieve financial freedom by teaching you the foundations of trading stock options. Join our growing community. Learn through our live-streamed weekend course, or develop your skills at your own pace online. Understand how the stock market works and how you can use the options market to earn additional income. Achieve financial freedom and live life on your terms. Let us help you build your empire.
Hey, it's Sarah from the Everyday Investor, and we are talking to Kyle about financing and mortgages, and we are going to be diving into a specific deal. Welcome back, Kyle.
Hey, Sarah, happy to be back.
All right, awesome. So what type of deal are we going to really dissect today?
Yeah, so we're going to be talking about private lending and how, as a lender, we can really become the bank. I think everyone agrees that banks make good money. So how can we as an individual, we as an RRSP, or a HELOC, how can we lend our money and be the bank? So I have an opportunity that we can talk about today.
All right, very cool. Private lending is not something that many newer investors really are familiar with. But it is something that happens a lot, especially the more unique deals as and as people scale up, they're going to utilize some of that. But how, what kind of private money? Give us some examples. Like, are these is this cash that somebody would lend out? Is this RSPs? Is that all the above?
Yeah. So first of all, in the private lending space, it really, I'm going to use the term, it was kind of an old boys club for a long time. Lawyers, accountants, high net worth business people kind of did this on their own. In the last several years with social media and the growth of real estate, it's really become more accessible to people. So we have many lenders who lend their cash. So their hard-earned savings, they lend their cash. They're also tapping into some of their equity. If you lived in Canada for the last 10 years, you likely have a bit of equity there. You can tap into that via a HELOC and lend that. And really where we've seen growth in the last, I would say, couple of years is in the RRSP space. So we work with an administrator, and you can lend your money secured from your RRSP at 10+%. And we're really seeing Canadians turning to that as a solution for income and retirement.
Absolutely, and I will say banks will not divulge this little secret, because that means that you would actually take their money and move it somewhere like Olympia Trust or another company along those lines, depending on where you are in Canada. And they don't want to tell you that because they want you to take that money and invest in their mutual funds, because that's how they get paid. But there's a whole realm out there that you can borrow and you can lend private money, whether it's your RSP, your tax-free savings account, your cash, your HELOCs, and vice versa, and you can receive. And I think, that once people start going in that direction, I mean, financing and access to money just becomes a non-issue or much less of an issue. And it's really just at that point about finding deals. So what deal are we dissecting?
So today we're going to talk about, I have a project, it's in Ontario. It's just south of Tobermory. It's a campground trailer park. My clients are purchasing this property, and they're going to be doing some strategic value add stuff, renovations and additions to the property. And we're going to be running an operation out of there. So that's the deal we're talking about today.
Awesome. So a campground, is it on the water? Is it a little bit further away?
It's more inland. It's off Highway 6 in Miller Lake. I won't give the specific address here, so we don't have people driving by. But happy to touch base with anyone after the show that wants to talk about that. But so it's inland. It's a large acreage, currently being operated as a trailer park. My clients are purchasing this property, and they are going to be doing some strategic more updates to it. So just to kind of give you some insight, many of these campground operations are very family run. They've owned by the same people for a lot of years, and typically we're seeing these operators, having what we call resort burnout. So they run it, they clean the toilets, they plug in the trailers, they sell the tickets at the front, and versus the new generation of operators are going in with more of a business ownership mindset. So the guys that are purchasing this are going to be doing some cool additions like tiny home Airbnb, Airstream renovations. So those cool silver RVs are going to be renovated, doing Airbnb, and they're also doing the yurts. The yurts are those trendy picnic type things that are going on. So really on point. We're seeing the people from GTA and other major cities looking to get out into these more rural areas and enjoy a cool type vacation. So that's the high level of the deal. Yeah.
I mean, it sounds awesome. And ironically, as you're saying this, because I don't know if you know this, but I ended up buying 6 acres and we're actually building a resort and we're going to do some really cool, unique stuff as well. So obviously in a completely different area of, mine's up in the Kawarthas, but I think this is, the new way to experience from a consumer, even a new way to experience a vacation. And especially with the pandemic and everything, people might not be traveling as much or might be trying to figure out ways to stay more local and still have a great time. Great concept. And I do agree with you. Back then, it was them working in the business. I think now, people that are looking at these types of properties, you're working on the business and you're going to be building the systems and the processes, procedures, all of that good stuff. In my case, I did a vendor take back, but how did these folks here get financing?
Yeah, so and that's where they've come to me and my investor pool. They are looking, in terms of the deal, they're looking for a $1.5 million first mortgage on the property. And they are going to be paying 10% annually on that money. And in order to get you off your couch and excited to lend, they're going to be paying a 1% lender bonus to you as well. So if you were to write a $100,000 check in this deal, not only would you be getting 10% on your money, you're going to be getting a $1,000 bonus up front for your troubles.
Awesome. So this could be somebody that, is not necessarily interested in tenants, toilets, all that stuff, but they are just wanting to lend out their money, live off, that income, whether it's monthly or however you set it up, plus get a bonus. So on every $100,000, one lender point, that's $1,000. You lend $1 million, and you can essentially do the math from there. But 10% is good. So walk us through how you are structuring this for them.
Yeah. So this is a group mortgage. Every single lender will be individually registered. So they own a percentage of the first mortgage and they're paid directly by the lender. So by the borrower, pardon me. So with a file like this, we have a $100,000 minimum. That $100,000 can come from your HELOC. It can also come from your TFSA or RRSP. So the number one question I get asked is, well, Kyle, we make money on this, but we have to pay taxes. Yes, I don't have the magic solution there, except for the fact that as a Canadian today, if you've been a resident of Canada and over the age of 18 since 2009, you have a $75,500 tax-free contribution space, and you can lend funds through that and not pay any tax on your earnings. So beyond that, we structured this deal as a 1-year term. So the funds will be invested for 1 year with a 6-month close period. So what that means is the borrower is committed to borrowing the money for at least 6 months. If for whatever reason they win the lottery, come into a windfall of cash and want to pay you out on month 4, they still got to give you that additional 2 months of interest. So that close period is in there to protect the lender. Speaking of protection, the number one thing that people ask is, what's my security here?
Right.
How am I protected? So you're registered as a first mortgage on this property. So you're registered in first position for payout. The next question I get, well, now I got to pay a lawyer to do this for me. The great news is in these transactions, you have a legal representation paid for by the borrower. So the borrower will pay your legal fees on this transaction.
Amazing. So really it's 10%. I mean, if you look at what you're getting in the stock market or a GIC, I mean, maybe the stock market, you're getting what, 5-6%, maybe in your mutual funds or whatnot, even less if you're invested in GICs. I don't even know if you're getting 1% at that point. So this is 10%. And so are these, because one of the questions that I think of when I lend out my money is, who am I loaning it out to? Are these people, investors that have done this before? Is this their, brand new project, first time in the market, first time partnering together or whatnot? Who are some of these people that are bringing in that income, and why would I want to invest with them?
The key differentiator between the private lending that we do and what you see in most of the market is everything is investor focused. Often when you have a private money request, it's because the borrower is in a bad situation. Maybe they lost their job, girlfriend broke up with them, can't find their dog, all of those things that happen in life that they need private money. These specific files that we deal with are investor focused. So these are 4 clients that are the borrowers. All 4 clients have great credit, solid income, and are higher net worth. So each one of the borrowers have a net worth of over $1 million. The question people ask is, why on earth would these people borrow money 10% if they have all this other money? The answer is their rate of return is higher. On this transaction, the value of the property is substantially higher than what they've paid for it. They're going to be doing strategic value add renovations that increase the value of the property beyond that. And the income that they generate is going to also increase that rate of return. The answer is their rate of return is substantially higher than 10%. So they're looking to access capital at 10% to allow them to grow and scale faster.
Sounds like a win-win, right? So they're doing well, they're going to make an amazing ROI, and as a very passive investor, somebody could just, keep doing their thing day to day and collect money every single month. Is this a monthly payout? Because sometimes there's quarterly, sometimes there's monthly. How does this one work?
Yeah, so we do monthly payments on the bulk of our files. So this would be a monthly payment. Every single month you're receiving electronic transfer with your interest rate based on the dollar you've invested.
Okay, awesome. So if somebody is sitting at home right now saying this could be something I could do, or I want to learn more about how I can do a deal and bring in some private money and whatnot, where can people reach out?
Yeah, shoot us an email, info@kylefordmortgages.com. Let us know that you'd like to be added to our lending list. We'll send you that information right away. Before you do any deals, we're going to have to get on a call. We do have to make sure we know your situation, making sure that this is a suitable lending opportunity for you. But if you're interested in just seeing what this is about, touching it, feeling it, getting some information, info@kylefordmortgages. Myself and the team, I have 5 agents, 2 administrative staff. We're all here to help and service the lenders and the friends of the show. So don't hesitate to reach out. Don't feel pressured to do a deal with us. If this is something that you just want to talk about, reach out. We'll have those initial conversations. We'll get you on the lending list. Ask us the tough questions. Get us on a call with your lawyer. We're totally okay with that. We want to make sure that not only are you getting a great return, but you're comfortable, confident, and secure in the lending you're doing with our team.
Absolutely. It's important to have all the facts in order to make a decision. And, folks at home, reach out to Kyle. I mean, you have a great reputation in the industry. Kyle, thank you so much for being on the show.
Thanks for having me, Sarah. Always a pleasure. And I love giving back and helping new investors get involved here. So
awesome. And thank you at home as well for tuning in. Don't forget, same day, same time next week. And we've got another great episode. I really enjoyed learning about how to borrow and loan private money and answering your questions out there. So if you do have questions, reach out to us at our website. We will indicate it below, and our Instagram account, and let us know what mortgage questions you have, because we are here to serve you and educate. Thank you so much.